Ferg finds deep value in areas no one else is even willing to touch, and you make some early stage investments, and right before they take off, and it's just brilliant. So really happy to have you on.
Cheers, thanks for having me back, Elliot.
Where do you think we are with uranium right now? Because it has corrected a little bit, right?
Yeah, I think it just you can zoom out a bit to the whole reflation trade. I think it just ran a bit hot. So I think we're just like anything, you can't expect it to go straight up from sort of left to right. So I think we're just going to have a wee bit of a correction, a sort of that'll probably go on for a few months, and then we continue higher. But yeah, I think it was needed. I like to look at like copper as kind of the lead indicator for the whole reflation trade, and that just sort of stalled out. Even good news couldn't take it higher. So yeah, I just thought it was time that we have a bit of a pullback and wash a few of the sort of tourists out, as always. Yeah, right. And also people don't understand that just staring at the spot market isn't what's going on. They the quick overview of sort of someone that's just come to the sector is, if all these people were buying spot, why isn't spot spiking? The thesis is null and void. I'm leaving. Cameco's bringing cigar back on. That means there's going to be plenty of pounds. Like, I'm going to move on. And so it's a good thing to get some of these people out of the market again, have a bit of a reset. And yeah, that's pretty much my view. There's nothing to worry about. I'd like it if it goes a bit lower, because I still consider adding to some positions if they pull back another sort of 10% from here. But generally, I've pretty much moved on from uranium now. I've got quite a large position size in the portfolio, so that's pretty much my thinking on it.
People are getting pissed, right? That are in it, because they all bought, like, I mean, not all of them, but like most of them bought pretty high. So here we are, probably down 15% in a lot of the positions. Yep. So it's you're still just as bullish though, and you'd still be buying around here.
Yeah. Okay, great. Yeah. A lot of these people are just doing poorly relative to like Dogecoin or something. It's all a relative game. Yeah. So
yeah, that's what do you think of Dogecoin? Do you think it's just an absolute ridiculous mess, or what?
Yeah, well, I find it interesting just because I quite enjoyed Peter Schiff, because he always gets trolled relentlessly on the sort of the comparison of gold to Bitcoin. So I enjoyed him doing a bit of trolling back, saying that obviously Doge has completely outperformed Bitcoin. So obviously it's taking over using their sort of their thinking against them. So it just shows that there's a lot of easy money out there. There's a lot of speculation, and yeah, something I've been considering is kind of, yeah, like it is. I've been reading. I don't know if you read Cuppy's stuff. There's also some good thinkers like Luke Groman that just suggest that, like, we always fight the last war, or generals always fight the last war, and this one everyone's got sort of the global financial crisis and sort of crashes so fresh in their memory that the real risk now is going to be being far too easy, sort of going down the whole continued stimulus route. And whereas you get some sharp corrections, everything's going to be higher highs, and it's going to be this sort of transitory period of inflation, which is anything but transitory. And a lot of things just keep going higher, and people get angrier and angrier because a lot of people wanted that big reset to kind of get in. But yes, it's something I'm considering at the moment, is what happens if we see everything just keep sort of grinding higher on the back of sort of debasement.
Right, absolutely. So you don't think it will be transitory? You think it's kind of secular, and yeah. I mean, I guess if you crunch the numbers, they have to debase the currency by trillions and trillions of dollars to meet the demands. So
yeah, well, it's just the idea that it's kind of that they're caught between a rock and a hard place when you consider that they so the stimulus is going to keep going, because you've really only got three things to choose between to handle the debt. You've got austerity, you've got default, and you've got pretty much inflation or debasement. And so that's the sort of the easiest road for central bankers and government. So they'll always take the easiest road. From there, you've got the fact that that's going to mean that they're going to have to keep buying bonds. As soon as rates start to rise, they can't have rates go much over 2% because then becomes too much of a burden on debt servicing. So they'll have to do some sort of yield curve control. At that point, once you get yield curve control, they'll have to buy more and more. People, like 60 odd percent of US assets are held overseas. Once they see themselves being debased, they'll start moving out, and that'll cause them to, the Fed will have to take up that slack, more debasement. And yeah, from there, I just see that's kind of a nasty sort of feedback loop. And that's really the sort of the overview of why you want to be in commodities or anything with a real sort of cash flow that can defend you against that.
Right, absolutely. So they're going to sacrifice the dollar to keep these bubbles pumped up, right?
Yeah,
and
exactly.
It might work, at least to keep the bubbles pumped. So that's why there's crazy speculations and stuff like Dogecoin and cryptos and stuff, right?
Yeah, exactly. So it's just, the only thing that'll end them is if there's real sort of pullback in liquidity. It's
not likely.
And not likely. You could have some monster corrections and sort of flush outs, but there'll be sort of more and more liquidity. So I wouldn't short anything. I wouldn't be caught dead short anything. I just think you want to work out something that's got a fundamental story that you can get really long and have conviction in.
Right. So you have conviction in commodities currently. You're not kind of tempted by some of these tech stocks that have come down a little bit. No cryptos or anything for you?
No. So my sister, I often joke, she's my hedge. So she's founded her own blockchain startup. So she's got like MindSpider. I give her some money occasionally, and she does some crypto, does something in the space, whatever she's seen value in. But I don't understand it. I've never understood it. So outside of my circle of competence, and I stay away. I'm doing just fine in what I understand.
Oh yeah, absolutely. That's the thing about commodities. A lot of them have just taken off since March of 2020. They're just all in kind of, well, actually since then they bottomed, they just spiked up. So that's my question for you, because you love deep value. You love finding stuff that's hated. And would you agree that if you like an asset, the worse the chart looks, the better for buying?
Pretty all to an extent. So there's a point at which I do rely on technicals in a certain way. Like I love seeing a chart crawling along the bottom, refusing to go down on further bad news. Some good examples at the moment are still in the sort of the offshore and the oil service sector. Like they bottomed like 6 months ago, and regardless of what happened in the broad market, some of these, like you have the like the stock indicators. I've just got a MacBook, and when you flick them across, like everything else is red, and a few of these are just put in 1% days, and you realize, they've pretty much flushed out everyone but the strongest hands in some of these names. And that's when I just continually keep chipping away and buying them. So I love that sort of compressed trading range sideways in a lot of these things. So some of the charts that would probably show that best at the moment would be some of the offshore service stocks. So like if you brought up like MMA offshore or CGG, which is like a geo like an oil service stock that does mapping for the ocean floor. And so some of those are just, everyone thinks they'll never be required again because their revenues are completely tied to the offshore sector, and they're just hated, but they don't want to go down anymore, really. They're just crawling along sideways, and all the offshore drillers.
Okay, so is that kind of like the place you can find the deepest kind of undervalue right now, is pretty much the oil service sector stocks?
That and coal. I still like coal a lot, but those, because everyone loves to jump. Most people just love to extrapolate a trend. That's why you see like everyone start to get excited about uranium when they can just look at the recent past and go, oh, this gone from whatever 10 cents to 50 cents, so I can see it going to $1. I like to be there when it was still 10 cents or even a bit lower, and by the time everyone gets interested, you're already sitting on a multi-bagger. And so that's how you get serious returns. You don't want to run with the herd ever. So I want to be places where people's like, oh, I can't quite do that yet. No one would agree with them. would agree with me. It would be cold and lonely.
That's where it's ideal to be, exactly the sweet spot when everything just looks terrible for it, and you're well known for doing that. So as far as these oil service stocks go,
sorry, he's barking at birds outside. When they land, he chases them off. Yeah,
my dogs are away right now. They're hiding. But so as far as the oil service stocks go,
oh no.
So it's tough, right? And I want to play devil's advocate because it's obviously very ballsy to go in on, right? And with oil, because it's totally taboo now. I've heard you draw comparisons to coal. They're both hated, but I think you were saying at some point, I've heard you say coal is so taboo that it's probably not going to get that multi-bagger return. Like tobacco companies, right? You'll get a good dividend and you'll get some decent growth, decent returns, but it won't be necessarily like, coal miners all of a sudden going up through the roof. Do you not see the same thing with oil, like the risk of just kind of there being a kind of a slower growth rate for that?
So I've had some really good debates lately. That's why I love to put out that thesis, because then I get some other people that are far smarter than me want to reach out and debate me on it. So I've had some good debates lately. Just to use one example at the moment, there's a company called Peabody. It's a coal company. And I had a good debate the other night on the fact that, yes, they agree probably the entire sector doesn't reflect higher coal prices, which is kind of my thesis. Like coal keeps going higher and the stock doesn't react. But saying at some point you get such a tight float. So just to use Peabody, it's produces roughly 5% of US energy, and it's only got about a $70 million float at the moment. So that's kind of easy to squeeze. So that gets to a point at which my whole general idea would become null and void, when you don't need many people to clue onto something to squeeze it at a $70 million free float. Right. And so I reversed my kind of thesis when I see situations like that. So I've been adding to that. And especially when you there's quite a divergence between, so they produce a lot of met coal. And so when you see steel prices roaring higher, you know that, and they also released in their 8K that they'd be doing well at sort of, I think it was $60 a ton coal, and coal's up around $90 now, if not higher. And so you kind of say, oh, that actually, this is a more one-off sort of example in the coal space. I still kind of maintain my thesis across the entire coal space that it won't attract these kind of crazy ESG flows. But when I see something like that with a super tight float, then I'm just like, okay, I'll increase that weighting, just because it would be so easy to be squeezed. But that was just a sort of a tangent to answer your question on oil in general. Especially the offshore space. I think it's just going to be the realization that that once demand returns and there is seen to be a structural supply, the oil majors have sort of pretty much 50% of their proven reserves with the offshore. It'll very quickly, ESG will kind of get overrun by performance. Like I always sort of say, like a lot of what ESG was kind of like a nice to have. Like you could feel good while you're getting the performance. Look at any ESG ETF or fund it was pretty much just like FANG. You just look at the top 10 holdings, and it might as well have been FANGMA, like Microsoft, Facebook, Amazon. Like it was just stuffed with tech. And so the interesting thing will be, if that stuff starts to underperform and energy starts to outperform, how many people are going to stick to their reasons for investing in ESG? At what point does sort of performance become more important than your ethical reasons? And I'd say, people will switch over pretty quickly and start performance chasing. It's just basic human behavior.
Right, that's absolutely the case. So were you a sheep farmer, or was your family sheep farmer?
Yeah.
That's why you understand herd mentality so well, and all this. I get it.
No, I grew up on a farm in New Zealand. Dad is sheep and beef. Yeah, I even studied agriculture at uni.
Okay.
Yeah.
But
set me up well for what I do.
Subconsciously saw how herds move in that direction.
Yeah.
Maybe there's some market analogies there. Yeah.
I have to think about it. Yeah, I haven't even tied that in.
Right. Right. So, okay. So then for the oil service sector stocks, you see a lot of asymmetry there currently, right? Just,
Yeah.
okay. So and that's based on supply demand fundamentals in the oil space.
Yeah.
So you've crunched the numbers and you see currently like all the shuttered supply with the fracking, the tightness. You think the market is very kind of like there's going to be a supply crunch essentially. Is that what's going to come?
Yeah, I essentially see once demand returns to, like, essentially demand and supply went down together, and everyone's assuming that they'll bounce back together. And I'm assuming that demand will bounce back even possibly even higher with all the, like, I know every friend I talk to, as soon as they get the green light, they're off traveling. They're off on their holidays. They're going to meet their family around the world. So I think you could even see oil demand overshoot for a period. And I think what's going to it's going to come to the surface is once that demand jumps up, we're going to realize that there's a sort of a 1 to 2 million barrel structural deficit from sort of end of this year to maybe sort of, yeah, it depends when this demand comes roaring back, maybe sooner if we keep the sort of vaccine rates high and everyone gets the sort of confidence to get going, or maybe a bit later into next year. But I think that real crunch is coming. And once that crunch comes and people start going through why it sort of happened and looking forward, they'll realize the shale isn't really going to save them in the way that, so like, it was like 90% of the additional sort of oil production over the last decade was from shale. And so with that kind of being in serious trouble, and largely, like, there's like a whole lot of reasons. If you go into like high grading, they've obviously burned all the investors, all the bankers, everyone. I don't think they're going to get particularly easy access to capital again. So I don't think they can do another boom as such. And so they're just not going to, supply is essentially not going to respond to higher demand, and oil, the price is going to have to incentivize more of this sort of more expensive oil. So that's more sort of offshore, and even then, offshore isn't that expensive anymore. I think I've got some charts that show it's had such a tough time since 2014 that its break evens are actually below shale.
Okay, so that's kind of the analogy. That's kind of how you're seeing it play out. So the ESG, they invest in green energy. They do not invest in fossil fuels, and this structural deficit that you're talking about gets worse and worse, and the price of oil just has to keep going up and up because of that, and that just causes all the related stocks to go up with it, and eventually the herds just pile in, and that's kind of the trade. That's really exciting because that's why people like uranium, because there's a structural deficit, right?
Yeah. It's just oil's harder to see. Yeah, uranium's kind of quite straightforward because you've just got reactors. Uranium's a rarity because that demand. That X number of reactors require X number of pounds, and they're going to contract, and they're not sort of finicky buyers wondering if they would like to buy some like gold in the future, like try and forecast that demand accurately. That's all just a guess. With a fuel buyer, they need X number of pounds per reactor. It's just a different equation.
Okay, and just playing devil's advocate here, a lot of people look at, like, I've talked to a few people that are deep in the oil industry, and they're saying, oh, the futures curve shows oil price going down over time, right? And part of that is because they think OPEC can just turn the spigot on and just pump out oil and flood the market. But what is your take on that, and why it wouldn't necessarily drown the market?
I think they can lift it up a bit, but I think they're relatively like a lot of what I think Saudi overstates a lot of its reserves. Like, there's people who've done some great work on Aramco. It's actually an interesting story of what they actually did there, because that was when they first tried to IPO it, they couldn't. They had to actually let people look at their books and like try and assess the reserves. And the first few sort of people that they had a look at it, sort of saying, throwing around, MBS was throwing around like a 2 trillion market cap, and the first few people that had a look at it, like, you got to be kidding! Like, this is maybe 1 trillion at best. And so he got pissed off of that. So he withdrew any ideas of IPOing. Then they just essentially listed it on their own market, and sort of told a few wealthy Saudis to buy it up. And then once they got got the valuation they wanted, they did a secondary on the market, and then they've maintained that valuation since. So that was the way that they kind of they floated it. So yeah, I don't subscribe to the fact that they can ramp anywhere near the structural deficit. I think a lot of the stuff that's come offline isn't coming back. Like a lot of the stripper wells that came off around the world, they aren't coming back. They weren't that efficient in the first place. And there's just been a lot of destruction around the world with lower prices. Like a lot of if you go around the world looking at a lot of the countries like Venezuela and stuff, they're just not investing in capex. Everything's just kind of been just sort of driven into the ground, and it's similar to what you see with US. Like it really the sort of the longer term, like coming back to this like with sort of a shale well, you've got such a large drop off. Like you sort of got like 40% in the first year, I believe, and then drops off pretty steeply from there. Whereas like an offshore project, a lot more upfront capex, but only sort of a 10% reduction each year. And so we just haven't invested in the more sort of long-term high production sort of oil supply, and that's going to come back to sort of bite us pretty heavily.
Great. Good. That's a great answer to kind of the thought that OPEC can just turn on the spigot and drown the market. You don't think so? Great.
No.
So, okay, the other bear case for it is, obviously, well, one I haven't asked you about actually is, so yeah, obviously oil is important for plastics. It's important for fuel. So if cars go the EV route, then there won't be as much need for gasoline, but also there's a lot of startups that are trying to come up with plant-based plastics, which would kind of cut into that market too. Do you still, like, even with all that investment in those areas, is the economy still addicted to oil, and will it still desperately need it going forward?
Yeah, 100% it will. It's so you can go through a lot of these, because a lot of these get put up as sort of bear cases, like the idea of like green steel, or like producing things with like renewable energy and stuff. The important point is to always dig through whatever you see and try and find the actual research report and find at what price it was economic. So that's why I just get annoyed by a lot of the sort of examples getting thrown out there. Like I actually went through green steel the other day just to use that because that's on the top of my mind. Is they were saying like green steel could replace like met coal, and so that sort of null and voids the whole met coal thesis. I was saying, well, show me what price that's economic, because I'm guessing with green steel you need renewable energy to make it, so you've got all that cost, and I've gone through that it's sort of orders of magnitude less efficient. So you've got all your problems. You got your problems with that. You've then, to produce the hydrogen to produce the steel, you've got to go through electrolysis, which is hugely energy efficient. So you're taking something in renewables that is orders of magnitude less efficient than standard fossil fuels or nuclear. Then you're then using a process that's orders of magnitude less efficient than just splitting hydrogen off natural gas, which is electrolysis. And so you then come up with hydrogen. And then the interesting thing was, I thought hydrogen would go straight in the blast furnace as a replacement for met coal, but no, it's only the first step, and so it only gives them I think it's pig iron. They've still got to then mix it with carbon and go through an electric arc furnace, which is hugely energy intensive as well. And so when you run through all those numbers, I was like, I'd love to work out how this could possibly be economic. So I read the research report and tried to find where they made the assumption of the economics of it. And buried in the bottom, they have to assume it was $60 to $80 carbon tax, and they have to assume that electricity stays at a certain level of cheapness. And so when you put those two together, they obviously need this monster of a carbon tax, and they also need what's happened in Germany and Denmark and everywhere that's installed renewables. Power prices have gone up. They can't have that happen. They have to have this level, and they have to have power stable as well. You can't have intermittent power when you're running an electric arc furnace. If you have a power cut, then all your steel goes hard in the and so bringing that back to your point with sort of the plastics, it's just to understand how economic is this, and is it actually competitive? Because you've got sure we can do little bits of it, and sort of some of the Western leaders, like you'll see green steel in like Sweden, or probably some of the plastics in places like Sweden and Germany. But it's again this idea that the developed countries are the minority. We're 1.3 billion people. We're not growing. The real growth in the world is the 6.5 billion in emerging or developing countries that are on their way in 30 years to 8.5 billion. So unless it's economic, they're not going to take it up. They don't have the money to throw subsidy after subsidy and sort of just weather the cost and pass all the cost on to their populations. They can't. They need the cheapest, most economic solutions, and that is by far still fossil fuels. And so a lot of the stuff is nice to have, and hopefully it gets economic enough that the emerging world will take it up. If it's same level of economics, then you'd hope that they would. But when it's kind of there's a huge gap, and there's no chance of them taking it up.
Yeah, fair enough. So you brought up hydrogen. What do you think of hydrogen long term? Because a lot of the companies are just so overpriced, right? They're just in the billions of market cap, the fuel cell companies. What do you think of hydrogen as a long term investment? Is there anything that's even possible that's undervalued right now?
No, it's a bubble. It's a complete bubble. That's going to implode at some point. Well, then again, I wouldn't short it, but it just makes absolutely no sense. The only thing I've actually seen that interested me with hydrogen was the idea of like molten salt reactors, which are a type of sort of more small miniaturized nuclear reactor. And I was reading a research report on that the other day, that they can actually put off thermal energy as well as produce power, electrolysis, and that actually can make hydrogen for roughly the same price as splitting it off gas, if not cheaper. And this is the first time I've actually seen something that I was like, that makes sense. That's super attractive, because what's happening now is with renewables and using electrolysis, like electrolysis is hugely inefficient. So to give you an idea of how much power it would just take so hydrogen is just used for refining in the oil and gas sector. So they just need it for that. So just to replace what the world requires in hydrogen, just for that, using renewables, it would use more. It was 2,600 terawatt hours, which is more than the European Union produces from all its power. So it's just to kind of give you an idea of just how inefficient it is. So these things have got no economics at all, producing hydrogen with electrolysis. It makes zero sense. Yeah.
Great. Okay. So it's kind of a pipe dream then.
Yeah.
Bubble built around a pipe dream. Okay, great. So then what are some of these really hated, undervalued oil service sector stocks that you think investors should at least research? So Noble Energy Corp, we talked about, it hasn't come out yet, right?
It's annoying me now. It's just taking forever. Yeah. Give them their due. They have done a merger or acquisition, and still in this period between exiting bankruptcy, exiting Chapter 11, and actually relisting. So they merged with Pacific Drilling, so they've got an extra 7-8 drill ships, I think.
Are you still interested in that company?
Yeah, I am. I just want to see what they relist at, because I can't just say buy it sort of regardless. Like they might relist it at quite an expensive premium, which makes it kind of unattractive relative to the likes of sort of Transocean and Bohr. Like they are going to be a reasonably safe bet in the way that they've most of these companies are absolutely drowning in debt and have high debt servicing. So they've wiped out their 3.5 billion of debts. They've coming up sort of 400 million of debt. They've got no maturities for 5 years. But if they slap a super high market cap on it, then and it's, I don't know, say for argument's sake, it's the same price as Transocean, which has probably got 3 times the order book, then you'd have to say, oh, that's they've overpriced it. That's getting a bit silly. I might as well. I probably still, I don't know if I probably wouldn't buy it then, but so say it's somewhere in the middle, then maybe more of a basket approach. Because one of the things with these companies with high debt and being riskier is it's a double-edged sword. If things do turn around quickly, then they'll outperform as well. So, and the closer we get to, I think, this kind of inflection point of people realizing these sort of structural deficits are out there, the more that you kind of want to be in some of this sort of riskier stuff. So it's really a balancing act in that side, yeah, in that way.
Yeah, basket approach makes a lot of sense to get exposure to this space. So what are some names that you think are just totally undervalued right now?
So I'm really liking just the offshore services at the moment. So I've written about Tidewater. So that was another bankruptcy holding, another one that went bankrupt in 17, 18, and that so this has offshore support vehicles. They've got a relatively new fleet. They're also the average age is just over 10 years, and most of these are good for sort of around the 30 years. So um, they most of the trading at like 10% of depreciated value following the bankruptcy. And so no one can compete with them at the back end. In the bankruptcy, they got rid of all their unprofitable contracts. They got rid of a lot of their debt. So their sort of cash to debt positions, not too bad, or actually pretty good. And so when you see something like this, you see they're just no one can compete with them when the cycle turns. And so yeah, so it's just pretty much got the big one of the biggest fleets of like offshore support vehicles, and
Okay.
so yeah, that's
$470 million market cap.
Yeah,
That seems low, right?
Yeah,
Yeah, and it's run from like $6 to I think 12 now.
it's still super undervalued. Yeah, it's been improving, high grading their fleet, so they're just constantly. It's kind of interesting when you see something high grading is usually used in this sort of a negative term, like you're kind of overusing your best assets. But with them, they're sort of constantly kind of upgrading their fleet for the newest and best, and so the assets almost getting better as they go on, ready for a sort of a turn in the market. And so I really like them.
Okay.
I really like some of the bigger players that people I think just have had a sort of knee-jerk reaction to, like Saipem. I've kind of written about that before, that Saipem's this big Italian, was kind of labeled an oil service stock, but it's actually it's actually more of almost an infrastructure company. So it's got 5 different divisions. They build everything from wind farms to sort of all sorts of sort of platforms and all sorts of construction projects. So their cash flow is actually pretty solid. They've been paying down debt. They're looking really good. And for anyone a bit more adventurous, they do have options on the Italian exchange that go out nearly 3 years. And so those are super attractive.
That's great. How about just one of the ones that you mentioned actually was TK Tankers.
Yeah.
Do you like that? Because I actually looked into them, and they, really tiny market cap. They seem to have their debt under control. They haven't run up that much. I think they bought it at like 950. Now they're 12. What do you think of TK Tankers?
Yeah, I still just chip away. I've just got a pretty simple basket approach with tankers. So I just whenever I have a bit of spare cash in the account, I just kind of set a buy order 5% below the market for them, DHT holdings and Uranav, and I just keep chipping away. I've got it's kind of running off Uranav's some of their sort of figures for how much sort of scrapping there could be in it. There hasn't actually been that much scrapping, so it's looking like the thesis has been pushed out a bit more. But it's kind of what's great with a lot of these sort of more when than if questions is if I get another sort of half a year of just slipping another few thousand in a month, then I'll just have a far bigger position by the end of it all. So I'm just happily buying when I see sort of value. When I see these have a big down day, I'll just slip a bit more money into a sort of a basket of them, especially because I'm essentially trying to rebalance my reweight my portfolio because it's got so uranium heavy. I'd really like to have more exposure to offshore and tankers before I think they see their inflection. So I'm not actually too worried if we have another year before it actually inflects, even though I don't think it'll be that long. I think with sort of travel roaring back probably in the coming months by the looks of things, then a lot of that will they won't be able to miss that structural deficit for that much longer.
Great. That's good to know. Yeah. Because obviously, the more the current administrations neglect oil, the more it could still go down before the structural deficit takes hold. So you're saying it could be a year, which is fine. I mean, that's a decent time.
Yeah.
to get in early. Okay, so then what I kind of want to end on tin, because I've heard that you're bullish on it, but I don't know exactly why. So could you share kind of what you're bullish on with tin?
So tin just start with it's a tiny market. So I think it was only trades. What was it? 350 tons a year. To compare that with something like copper, which is like was it like 7 million or something? Yeah, no, 70 million. Yeah, and so once you just understand, it's a very tight little market, and it's got some interesting characteristics in the fact that a lot of it has kind of been produced by Myanmar, which is obviously having a lot of troubles at the moment with sort of its coup and a lot of sort of violence, and that already high graded a lot of their resource. So they were providing China with a large proportion of their tin. And so when seeing what's happened there, China's kind of realized, and so it's always quite interesting seeing what China's doing, because they're thinking a lot further ahead than the West ever does. So they've already started financing loans to buy commodities, and they subsidized, I think it was 70% or maybe even 80% of the interest on loans to acquire commodities. So they were trying to buy up, I think it was, I can't remember how much tin it was, but it was a lot. So they're trying to stockpile a lot of this. And at the same time that you've got see a huge impact on sort of global tin supply, whereas the demand, like tin's essentially the main sort of driver is for like solder. So everything electronics requires a certain amount of tin. And with what's happening globally, like if you've seen like all the sort of polarization between China and US, then a lot of these just for security of supply, a lot of production is going to be brought in domestically. Like, to use one example I was reading about earlier, was that Ford can't produce, it was 250,000 F-150s. So they're one of their more profitable lines. They can't get the semiconductors for them. And so they've just had to discontinue the line. So I think the world's kind of really, well, not discontinue the line, but they're going to have to dial back production.
Right.
And so you're going to see a world where price isn't going to be the main consideration. It's going to be security of supply and then price. And it kind of feeds into my whole sort of inflation outlook, but that's also going to be quite good for a lot of these sort of smaller commodities, is they'll be prepared to pay up to secure security of supply. But yeah, tin's just a story whereas commodities, you can kind of, I never like to concentrate too much on the demand side. I like just to see like pretty severe supply destruction, because I generally think demand's forecasts are a bit sort of esoteric. Like you can, two different people can come up with very different sort of demand forecasts. If you sort of say EVs will require this much and all the countries will meet their EV aims, and you'll require this much by then. But when you just look at the supply and find somewhere where there's really bad supply destruction, then generally you'll be rewarded for it, because demand can waver, but supply structural, and with all the underinvestment in capex, that takes a while to rectify.
Okay, so tin, has the price gone up a lot? Has it been on a tear recently? It kind of
it has. I think it's pretty much doubled. Yeah, I think it was 15,000 to 30. I think it's around maybe just under 30,000 at the moment. Yeah,
but it plays a huge role in the electrification of the economy, right?
Yeah, Great. Semiconductors, everything. Yeah. It's just the same sort of copper story as well. Yeah, and of course you've got the whole, like most people just think of tin cans with it, which isn't. It's kind of a smaller proportion, and that's in decline. And so that's kind of the story that usually gets that's kind of got the front of people's mind. A lot of it's like recycled, like we're quite good at recycling tin, but yeah, it's this kind of requirement for electrification, for EVs, for renewables, for building out infrastructure. Like if everything's to have more sort of electrification, then that puts a big tailwind behind. And at the same time, just having this sort of destruction and supply across the board.
So I was talking to the CEO of Nova Royalty, which is a copper and nickel royalty, and he was just
Yeah.
obviously incredibly bullish on copper because
Mm.
he said in a report called "Copper is the New Oil" that Goldman Sachs put out. Because
Mm.
yeah, I'm sure you disagree, but
Yeah.
because obviously just the way cars are going to run on it and how I mean it will be a huge part of the electrification of the economy, but it's almost like a no-brainer, like just invest in copper if you're bullish on the electrification of the economy, EVs. Is that do you agree with that? Like kind of go overweight copper?
The quickest way to respond to that is what percentage of my portfolio is copper, and it's probably 1%, maybe 2%.
Oh,
So I've kind of got a view that you want to split the whole commodity complex between ESG and non-ESG. Yeah, so between ESG and non-ESG. And so with that, you've got all I see with non-ESG is essentially heavy supply constraints. So to use like Anglo American the other day, they're talking of divesting of all their coal assets, and so a lot of this is to please like sovereign wealth funds and also the likes of BlackRock and Vanguard. If they hold big positions, then by default they have the votes, and they're now got an ESG mandate, so they push companies in the ESG way. So all that's doing is trying to defund coal and oil. So you're trying to pull out the capex, and these companies have obviously got to make up that revenue drop. So they're pouring more capex into the future of electrification because that's ESG friendly. So that's seen far more money poured into copper, nickel, anything that sort of benefits the battery revolution or transition. And so I want to be on the side of the stuff that's getting underfunded, that's getting more supply constraints. And so, yeah, like talking nickel's pretty much the only kind of exception to that rule at the moment, just because I see such a tiny market and I see such supply constraints. But other than that, my majority of my portfolio is non-ESG compliant, apart from uranium, which has pretty recently been invited to the club. But yeah, I think when you kind of go across the board with that, yeah, you can come at it from another way as well, which is the fact that a lot of if you believe that there's going to be sort of food and energy inflation, which I do, if you look at a place like China where they got quite high food inflation, especially like pork and stuff, then they can't squash food and energy inflation, so they have to start suppressing inflation in other areas. So they sort of clamp down on the property market, they clamp down on sort of property speculation. And I think it's possible you could see something like that in the West if we start to get rampant food and energy inflation, that they'll have to dial back the stimulus. And so a lot of these projections for EVs, for renewables, for electrification, if they're reliant completely on government subsidies and government stimulus, then they could really disappoint. And so I kind of don't really buy that thesis. And if I kind of hedge it by, if I'm long sort of stuff like met coal, even if I'm wrong and the transition absolutely goes from bottom left to top right, then met coal, to build an EV, you need 700 kgs of coal. You need it's gonna benefit regardless. All these commodities are essentially a large percentage oil. Like you don't get anything out of the ground without it being probably at least a third oil. So they're all an oil play in themselves when you think about it. And so you kind of win either way. So you're better off going with like kind of what I said before. You're always better off sticking with what's the most supply constrained. And you can just see this if you read, like just type sort of BP into Google and look at a lot of the articles of them saying they're no longer a oil company. They're fire sailing a lot of their carbon intensive assets, and they went in the other day and they paid double the last price for a wind farm in an auction. So that's the definition of selling low and buying high. So it's just destroying shareholder value, putting and a lot of these companies are doing the same. BHP, the big sort of Australian miner, they've been put on a warning list by the Norwegian sovereign wealth fund that they have to divest their coal. Otherwise, I think they own 2-3% of it. They'll divest it within a certain time frame. And so whenever you see stuff being done not for an economic decision, for sort of a for ideology essentially, then I always want to be on the other side of that. I was like even reading through some of the paperwork, and BHP was saying they were disappointed with the offers given for their coal assets when they put them up for sale by the likes of, I think it was Yarn Coal, which is sort of Chinese backed. And of course they're going to bid low. They know that you're being forced to sell this. Why would they give you I think they wanted $1 billion for it, and these guys are probably coming in half of that. Why would they come up and give you what you want for it? Yeah. So that's kind of an overview of how I think about that whole electrification.
I got you. Yeah. You want to be, because there's more asymmetry on the non-ESG funded industries. I get that. That's brilliant. Okay. And then 10, how do you invest in that?
So the majority of my position is just Alphabin. So it's a bit riskier because it is in the DRC, but it's a brilliant company once you dig into it. It's got 10 grades that are completely off the charts. Like its tailings are higher than most other projects out there. So if you can stomach being in the DRC and realize that they might do some dumb stuff like throw around some more super taxes or mess with the royalties and all the rest of it. But it's the no-brainer for me in the tin sector. So that's the majority of my exposure. But I've just can't get too big on it, just purely being in the DRC. So that's the majority of my tin exposure.
Yeah, that's a tough one. Okay. And then nickel. Did you see Elon Musk's tweet where he was talking about he's trying to move away from nickel in his batteries because it's too expensive now? He's trying to move toward lithium. Is that a concern at all for nickel?
Yeah, well, so I learned the hard way with that. So I had a decent position size a few years ago in cobalt, and rode those up to quite nice gains, and then rode them down the other side when the likes of like Tesla and stuff got rid of a lot of their cobalt and engines. Go. And so I've kind of learned my lesson. This is most of the stuff that I wax and wane about is usually from hard learned lessons. And so I started to think about something differently. It's not just from theory. And so, if you look at the second largest EV manufacturer in China, BYD, they've got rid of nickel and cobalt.
Wow.
Yeah. And so they're just doing lithium. I think, I'd have to bring up what the other constituents of the battery are, but it's, mainly, I think it's lithium ion boron or some. Yeah, I have to bring it up to remember what the battery chemistry is. Yeah, but they've largely got rid of nickel and cobalt. So when you consider that, it's
risky.
That's super risky. Like you can the prices haven't even started to rally yet, and so if you see nickel double or triple, this is obviously gonna become, there's be even more research poured into it. And these batteries, like you have the the sodium batteries that are essentially lithium and sodium, and so they also replace nickel and cobalt. And so you've got a whole lot of these technologies that are starting to get similar to the batteries with nickel and cobalt. And so again, comes down to this, like I can't bet big on that because it could be substituted out. It's kind of like what I learned with cobalt, which is why I'm comfortable having such a large proportion of my portfolio in uranium. Is they're not going to suddenly start running all these global reactors on thorium or something. There is no substitution. And so that allowed me to really push the chips into the table. Whereas you only have to look around and the votes are really still out for what's going to be the winning battery chemistry.
Wow, that is such valuable information. Instead of just diving into the current technology and batteries, like think about that it could be substituted out. Like you said, a lot of people got hurt on cobalt.
Yeah.
Brilliant. Thank you so much. So where can people go to find you?
These places, Twitter. I'm still fairly, I'm usually on Twitter most days. I just sit down and read stuff for probably an hour every night and bang out a few tweets. So Twitter is where mostly I occasionally write at traderferg.com. I do a email once a week where I just see the best of the article, podcast, video, some thoughts on a chart. So if you just subscribe at the website there, that's how get an email from me once a week with everything I'm finding interesting. But yeah, mostly just Twitter is where I'm mostly hanging around.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.